they're building what would be a actual have real faith behind if they have the ability to move it to a gold-backed currency. My question is, are they waiting until somebody like Japan blows up? And then once Japan blows up, who is next? That's the major question. I have my thoughts, but the question is, who is next?
If Japan really goes through a financial accident, which could lead to a monetary accident, right? Monetary accident meaning their currency really goes pear-shaped compared to other currencies. That creates a lot of chaos in the monetary system, but it also begins to expose to people the idea that a major currency could get in real trouble, right? And that shatters trust and faith across the other fiat currencies.
Does anybody really understand the ramifications, because that yen carry trade has been embedded in the system for so long
and turned into higher value add? So I keep my eye on Japan, because if we're going to have financial trouble or a monetary accident, Paul, I think that's where it would happen first. Not because Japan is the weakest element out there, economically speaking, but their monetary statistics are just a ghastly. You know how much debt they have. So, wake up this morning and here's a little blow up of this tail end way down here. But you can see this black line I've drawn across the bottom. The yen has not been this weak since, well, this chart goes back to 1996. The yen is now really weak. They've been fighting this line for a long time. Here's a blow up. You can see this is a big volume candle on this bit. This is when the Bank of Japan intervened. They intervened. It lasted about 3 weeks in this story, because this is a weekly chart. And then it had a bad couple. They fought it back again, and it's been drifting down ever since. But here they are, it well over 160 to the dollar. As of this, it's 161.55. So Japan is having real trouble controlling the price of its money, right? The value of its money.
Yes.
Right?
Yes.
So that's a bad sign. So, well, what do you do if you're a central bank? Well, you have to defend your currency. Unfortunately, you have to let your yields go higher. Yes. Because that will attract more money to come back in, right? Problem. Not only have the yields in Japan been going up, but they're starting to look almost out of control to me, Paul.
That does look out of control.
Kind of looks like it's picking up speed, doesn't it?
Yes. Yes, that's near vertical. Blow off.
And it's been bumping along the upper Bollinger Band for years, right? Like it has almost made no trips to the lower Bollinger. Back here it did a couple times.
Yeah.
But it's just been absolutely racing off. So this is the Japanese 10-year yield. Get that from at Finance Lancelot on X. And then this is also the 10-year plus the 20, 30, and 40-year. Paul, this is not good. Japan is, I think, it looks like they've lost control of their bond yields at this point in time. And so if your bond yields are going up and your currency is weaker, this is trouble at this point.
That's trouble. And, they've been a major source of liquidity to the world because of the yen carry trade. So my question is if this continues, does anybody really understand the ramifications? Because that yen carry trade has been embedded in the system for so long. If that's a major source of liquidity that comes out of the system because of their problems, they've reached the point that they can't control this anymore, and it obviously looks like that's the case. They're intervening, but they can't reverse the trend. Then that's going to be majorly impactful in certain sectors that I don't know that everyone can even calculate, because it's been so long without that yen carry trade.
So let's make sure everybody's following along, because this is why it's so important. I think that if Japan really goes through a financial accident, which could lead to a monetary accident, right? Monetary accident meaning their currency really goes pear-shaped compared to other currencies. That creates a lot of chaos in the monetary system, but it also begins to expose to people the idea that a major currency could get in real trouble, right? And that shatters trust and faith across the other fiat currencies, the dollar, the euro, et cetera, because they're all faith-based currencies, right? We're all kind of trusting that they're never going to go to zero or infinity, depending which way you're counting. But if Japan can't get this under control, this could get really bad. They may have to do something really dangerous, like capital controls or, pull their bonds off of the international stage or do something just to ring fence this. And all of a sudden, then what you were talking about, all these big cross-border capital flows, like the global economy has become one big giant series of interconnected pipes. And I don't know how you just turn the valves off at one set of them. I don't think that's possible, but it would get messy, I would predict. And that messiness could easily spill over into other financial markets. Lickety split, I would think.
If you're finding this analysis valuable, make sure to subscribe and turn on notifications so you never miss our latest market breakdowns. Now here's the bigger question. If Japan really loses control of its currency and bond market, could this be the first domino in a much larger global financial crisis?
I would think so. But what's interesting is you take Japan's backing of the currency and it's just faith. There's nothing for it. On the other hand, you've got China that's continuing to buy massive amounts of gold, rare earth metals and minerals. They have them, and they don't allow them to be exported out of their country for the most part. So they're building what would be have real faith behind if they had the ability to move it to a gold-backed currency. My question is, are they waiting until somebody like Japan blows up? And then once Japan blows up, who is next? That's the major question. I have my thoughts, but the question is, who is next?
So in a prior segment, we talked about oil, right? And obviously, if the Strait of Hormuz gets closed again, or worse, Gulf infrastructure gets attacked as a consequence of this, if it escalates. Again, Japan imports 100% of its oil, 100% of its natural gas, right? 100%, and so with the yen weakening, so you have to keep this in relative perspective. So the dollar, I haven't looked at it today, but last we talked, it was kind of hovering around the 100 mark, plus or minus, on the international scale. So when oil hit, and I got this insight from a follower of mine who called me, and this gentleman used to be the fuel hedging manager for a major airline. He worked in their treasury department. He said, hey, Chris, back when oil hit $147 a barrel in 2008, just be aware that the dollar itself was at about the 75 mark then. Now, with it at 80, and how could it be this cheap? But now the dollar's at 100. So from the U.S. perspective, that matters a lot, right? In how you perceive the price of oil. Let's now take that idea and just map it onto Japan. With their yen hemorrhaging like this, their apparent price of oil is getting more and more and more expensive unless they sell their treasury stash and buy their oil in dollars. So either way, this is going to put a lot of pressure, I think, on what Japan has to do. And I think this will probably convert them into net sellers of treasuries going forward, which I don't think is going to be so awesome for the U.S. interest rates. We'll get to that later. But
if they happen to start doing that, all things being equal, I would assume you could see it in treasury rates going up across the board.
We'll take a look at that in just a minute. But here's the Bank of Japan. Here's their issue. Do they now raise rates? Well, rates are already going up, and the yen is still slacking off here. So the only thing you can do in a situation like this is raise rates even higher. So Japan's Bank of Japan, I know they just took their core benchmark rate and raised it to 1%. Way too little. They may have to start really raising that. Problem. I've heard, Paul, that if Japan has an average rate of interest on their outstanding government bonds of about 2.3%, 100% of their tax revenues will go to interest service payments.
Wow.
That's where you get into the doom loop, right?
Yeah. That's a major doom loop.
Yep. And so you can't raise taxes to really make up for that because your people are already suffering from this imported inflation because your yen's going down. So all the things that they might have to buy from abroad, which is mainly energy, also food, those things just go up. So taxing people while they're getting, squeezed, very unpopular. And of course, Japan is a much more responsive society to its own citizens than I would say we do, right?
It really
Politicians
is.
are much more responsible. So they don't just sort of say, well, deal with it, peons, we're raising taxes because we hate you. They're going to have to live in that culture and society. And it's just good. Let me put it this way. Japan doesn't have any easy choices left.
No, they don't. And talking about caring for their citizens,
One point many investors overlook is that financial crises rarely stay inside one country. When confidence starts breaking in one major economy, markets around the world can react much faster than most people expect. That's why watching global trends, not just the US market, can be so important.
Really neat story. I don't know that this would happen in the US. I guess it was 2 or 3 years ago. There was a train line, a train path that went into a remote city or remote town to get into the city, and there was one girl that was taking it back and forth to get her education. That was the only one. They kept it open until she got her education completed. That's caring about your citizenry. I don't know that would happen in the United States, but it certainly happened over there.
It would not happen in the United States.
It would not.
In fact, several thousand people could get cut off because they're like, it doesn't make sense anymore. You know?
That's right. That's right.
All right, so that's Japan. The other part of the story I wanted to bring in here is South Korea.
Yes.
Now, South Korea's stock market's been doing some crazy stuff, and I got a chart on that in just a second. I mean, just crazy. And let's be clear about something. The Asian culture has a very strong gambling gene built into it, right? And I've heard that the South Koreans in particular were going all in. They were taking out mortgages on their homes. They were borrowing money. They were margin debting, whatever they could do to just participate, because this is the Kospi Composite Index for South Korea. And you can see here, like since 1989, it's sort of been in this, here's the channel it was in. And then right here in 2026, when everything went crazy, it jumped, Paul, not a little bit. It hit the upper band of this multi-decade channel it had been in, pops out at 3,500, goes to 9,000, a little over.
Incredible.
And as this is during the whole war and everything, of course, this is the AI boom. Of course, this is really driven by two stocks, really, Samsung and Hynix, which are both makers of memory chips, right? So memory is a big part of the AI story. What's weird is the whole time this is happening, foreigners were bailing. Since the start of the year, since the start of 2026, foreigners have yanked $100 billion out of Korean local markets.
Wow.
Okay, so if this is June, let's talk about what happened in July. Quote from crypto jargon here, quote, South Korea's Kospi just triggered its 6th circuit breaker of the year, the 12th in the exchange's entire history. So 6 circuit breakers out of 12, all this year.
In 1 year. Yeah, this month, really.
This month, really. And this happened the same day, he writes here, Samsung reported its best quarterly profit ever, $58.6 billion, beating every estimate on the board, and it didn't matter. And so this is important, Paul, because you know when bubbles burst? When there are no more buyers left.
That's right.
That's what this tells. Everybody was all in. There was nobody left to buy more. They were all in with debt, borrowing, leverage. Samsung cranks out some great earnings, and there was literally nobody left to buy. Plus, foreigners were sneaking out the back door.
Well, and the interesting thing is, I would assume that foreigner is institutional money, and they had their opportunity to sell on the average retail within that euphoria, and they exited. Because think of the average U.S. citizen. I don't know. I don't think maybe one statement that I have seen that's had exposure to the Kospi in the past 10 years. So that's institutions, because in the U.S., it's all S&P 500, NASDAQ, passive investing. So I don't know for sure, but I would assume that that's major institutions, and they had their chance and their opportunity. They took it to sell to the average retail investor who was margining their homes, borrowing money at the bank to catch in this euphoria, this gambling euphoria. And now, unfortunately, it's blowing up on them.
Well, I'm interested to get your take on this. I'm going to put a chart up in a different sort of view of the Kospi, a little bit just dialed in a tiny bit. But you run a risk managed strategy, and I know you watch charts like a hawk. So if this was in your portfolio, not saying it is, but if it was, tell me how you would read this broadening megaphone with this major breach here of the bottom side.
Yeah, first off, that's a major bearish signal. You know, it's not guaranteed. Nothing is 100% in the analysis.
History shows that market bubbles often end when there are simply no buyers left. By the time retail investors become the most optimistic, experienced institutional investors may already be reducing risk. That's why understanding market cycles can matter just as much as picking the right investment.
So if you had the opportunity, I'd be trimming at the top side of that wedge at the very top. But my line in the sand would have been a break of that double bottom right there at the bottom of this wedge where you followed through. I'd be out right there at the latest.
Right there. Just out. Yep. I mean, it'd be a little bit painful because you could have got, I mean, so it's impossible to pick tops, but you could have got out at 9,200, but still getting out at 7,600. I assume would be better than if somehow this thing snuck all the way back to where it was in just May of last year.
Yeah.
Getting out of 2,400 would be even more painful, obviously. I mean, that's astonishing. Look at that. 1 year, 2,400.
That's incredible.
9,000.
Well, and here's the good thing. So assuming that you've been in it for the past year, right? The one thing that I'll tell the listeners is everybody thinks that they're going to exit at the top, right? If it's a target in the portfolio, and let's say you had a 3 or a 5 or 7% position a year ago, and you start getting these extreme moves to the top side of that megaphone, well, now it's 14, 15, 20% of the portfolio. You can trim back to your original position at the top and harvest those. It's okay if you're to try to pick a top in the interim period, because if it keeps going, you're just prudently taking some profits. But the line in the sand that matters the most is when you break that trend to the downside. And you might hold on to it a little bit because you had that little bit of a pierce, you had a bounce, you had a little, you held that bottom. That's what you would call a double bottom. And then you follow through, you're out. And look, it may reverse and go the other way, but that's a decision point. That's a prudent position. You've locked in a massive profit. If you had it, we did not have that in the portfolio, but you did lock in a massive profit. And then you go hunt for the next opportunity. Or you just stand back and let it unfold. If it's a real good long-term trend that got ahead of itself, you let it unfold, and then you go back and you have the opportunity to redeploy capital potentially at lower levels if it's still a target in the portfolio based on money flow. But that's a clear exit. The problem is if somebody's passive, that doesn't matter. That's a clear warning. You had tons of warning before it happened, and then a decision point.